Thanks for joining us today. I'm Will Woodall, and I'm joined by Mike Rarey from CAP STRAT to discuss the market impact of Russia's invasion of Ukraine. It's a very unfortunate situation. It's a very fluid situation, and with a lot of different potential outcomes, with a lot of unknowns right now as we sit here today. We've been monitoring the situation for quite some time. It's not necessarily a surprise that this happened. It's been well telegraphed. I think if anything surprised us at all, it's the scope of the invasion. It's much broader than we had anticipated. The market reaction was quite aggressive last night. Futures were down considerably. Markets sold off at the open. However, as we approach the close today, it's been quite a reversal, and it looks like we're at an end in the green significantly across almost all markets here, especially the Nasdaq, which has had a tremendous reversal during the day. We thought it would be helpful to share with you how we look at these situations and the assessments that we make internally when we're confronted with situations like this. Mike's going to take us through some of the things we've assessed and what we're assessing in terms of going forward, how this might play out. But first, Mike, why don't you just give a brief synopsis of what's occurred so far?
Yeah, so far in terms of what's been happening in markets, we can look at all the markets primarily affected by the invasion. So starting in the upper left here with the S&P 500 index from its high on January 3rd, till sometime this morning, it was down 13%. Now, we know that all of this drawdown was not entirely due to the Russia-Ukraine conflict and tensions. So, we started the year down about 10%. We know that was primarily due to a repricing of the Fed's trajectory of interest rate hikes. And then we started to retrace some of those losses, recover some of those losses. And tensions with Russia and Ukraine were building during this time period when we were recovering losses. And then here we are again with another downturn, going below those levels we experienced in late January. So hopefully trying to find some technical resistance. But S&P from its peak down 13%. There are a number of different models out there that try to analyze how much of this downturn was from the Russia-Ukraine conflict. Most of the estimates are somewhere between 4 and 6% of this drawdown can be attributed to Russia and Ukraine by looking at the correlation of U.S. stocks with these other markets that are definitely have been more acutely impacted by the crisis. So if we go over to the right, sort of going in a clockwise fashion, looking at Russian stocks down 52%. I mean, this is definitely the impact of aggressive sanctions by the U.S. and its allies. These companies are not going to be supplied capital at this point. And so you can see the MOEX down 52%. The ruble down 21%. Once again, the long-term economic impact of these sanctions that have been levied against Russia, it's now at its weakest level in recent memory. So ruble depreciating significantly. And then finally, European natural gas up 40% from its recent low. That has been one of the primary leverage points that Russia has over Europe is it's supplying natural gas and Europe needing that natural gas so desperately. And so that has definitely created a frenzy within natural gas markets. Everybody scrambling to try to secure production, try to secure natural gas supplies.
What could make this worse for markets and economic and couch your response in both short term and long term?
Yeah, as we think about how this could escalate into worst case scenarios, I mean, we always think in scenarios and probabilities. So the first thing is trying to assess, what's the potential for further Russian action? They've already taken Kiev by all reports. So from here, how could this situation escalate or get worse? Obviously, if they were to move into any surrounding NATO country, that would be a very bad situation. It's a low probability event. It doesn't seem like that's at all Russia's motive, that's what they're looking for. It's possible that they could extend their aggression towards other countries in the region that are not NATO countries, other sort of former Soviet countries. That is a possibility. So that would be one thing that we would have to handicap. At this point, that's not our base case. Then the next would be further sanctions and retaliations. At this point, the sanctions, although they've definitely had an impact on Russian financial markets, on the ruble, things like that, they've been relatively mild in terms of the two big leverage points that U.S. and the Europeans have versus what the Russians have. And so for the U.S. and Europeans, it's primarily the SWIFT payment system. That was something that during Joe Biden's press conference today, that was left out during the Q&A session. He stated that we're not moving to cut Russia off of the SWIFT payment system. That would be absolutely crippling financially to the Russian economy, to Russian citizens, to Russian banks. So that has been avoided. And the idea is that is just as big of a leverage point as natural gas supplies from Russia to Europe. So Europe in particular has come out and stated previously that removing Russia from the SWIFT payment system is not on the table because they fear retaliation of Russia cutting natural gas supplies. Thus far, that's been avoided, which has been good.
The sanctions take time to work, and perhaps for Putin to feel the actual pain from them. So you're not sure if that's days, weeks, months. So that's why the outcomes are so difficult to predict here. But before we go on to that last question, in terms of market impact, do we see this as like peak market impact if things are contained here in the Ukraine, or what could escalate even further if things just stay limited to the Ukraine?
If things stay limited to Ukraine, there's obviously going to be a tremendous amount of volatility here, but it is quite possible that the worst may be over. So if you look at historical market events, for example, a drawdown of anywhere from 6 to 13% is on par with other major geopolitical risks. So that's what we're showing in this chart. So we took the Gulf War, 9/11 terrorist attacks, the Iraq War, when Crimea was annexed, and then obviously here with Russia invading Ukraine. And we're down 13%. Obviously, not all of that was directly due to the Russia invading Ukraine. But on average in these events, you go down 9%, probably about there. And then in most of these instances, you start to recover those losses to the point where 1 year out, on average, you're up 7% on the S&P 500 index. So that would be a rally of 18% from the bottom. So you were down 9, and then you end up 7. So there's a high probability that the worst is over here if we don't see any further escalation of sanctions or further aggression or anything like that.
Yeah, if you take the headline at face value, the worst is probably priced in, at least based on what we know right now. If you read the article though, the real issue is how does the Fed react to this, if at all, and that would potentially have a larger impact on volatility for markets.
Yeah, definitely. The Fed's in a difficult situation because in the past, they have cited geopolitical risks and tensions globally as reasons to be cautious in terms of tightening monetary policy. But the long-term consequences of this conflict could very well be inflationary and make supply chain issues worse. So they're fighting sort of both sides of this. And if we look at the Fed futures market, for example, and the overnight index swap markets, all of those things are suggesting a shallower path of rate hikes for the Fed and a slightly shallower path of rate hikes for the European Central Bank. It probably doesn't throw them off their path, but it is a reason for them to come out, for example, the Fed at its March meeting, and just speak a little less hawkishly or a little more dovishly, however you want to look at it, and basically take a 0.5 percentage point rate hike in March, hopefully off the table. And so this chart that we're showing here, this is the geopolitical risk index that the Fed uses and has cited previously. And you can see all the way out to the right, the most recent reading is 296. This is basically indexed to 100. So that's pretty elevated. I mean, they've shared this with the public. We know this is part of their reaction function. This would be a perfectly good reason for them to come out and say, hey, we're going to be cautious here. We're not going to hike a 0.5% in March. We're going to see how the data plays out. If this issue is prolonged, it will do nothing to help supply chains. ease. It will probably do nothing to help commodity prices come down. And we know commodities, oil, natural gas, all of these things feed through into consumer goods eventually. So, if this is prolonged, you could definitely see a situation where inflation does not moderate as quickly as the Fed would like or as we would like. And so the Fed may be conservative in terms of hiking rates early on, but ultimately has to hike more aggressively later to fight inflation, which we know would have ramifications for economic growth, the outlook, recession risk, markets, and all of those things.
Okay, so I guess the question a lot of viewers probably have is, what should they be thinking about in terms of their portfolios right now? Should they be de-risking? Should they be re-risking? What should you be doing in these situations, and what are we doing in these situations?
Yeah. In the very near term, this is not a catalyst to go out and buy stocks or go out and sell stocks. This is sort of a classic hold discipline type of event. There's not much you can really take from the market movements today. This is an extremely fluid situation. In our view, what we're thinking about is, how does this impact our full year outlook? How does this impact our game plan to manage client portfolios throughout the year? And, you could say on the margin, this potentially increases the probability of the bear case, but we ultimately have to see how the Fed reacts.
If you have questions on anything with respect to this conflict, certainly reach out to us. We're happy to discuss any of these items with you.